Don't chase returns. Markets will tell you something which has done terrifically well also goes through two things, which is either time correction or price correction. 10 to 20% allocation should be made outside India, because as the currency depreciates, when you invest into global markets, it actually helps you. The rupee depreciation helps you.
Welcome to part 2 of this exclusive podcast about everything that you need to know about investing globally. Today's expert, Mr. Vaibhav Shah, Head of Products and Associate Director at Mirae Asset Mutual Fund, is going to give you more details about how to invest globally. Stay tuned. Thank you for joining us today, Mr. Vaibhav, in this exclusive podcast.
Thanks, Nivedita, for calling me here for this session.
So, how beginner-friendly is investing via GIFT City?
See, any jurisdiction when it starts new is difficult for people to understand. And it's only with time that you get confidence. So I still remember when I started my career 15-20 years back, mutual funds were not a household name. You had to educate.
Yes.
What is mutual fund? How does it work? What is a trust? And now mutual funds have become such a household name that everyone understands the way mutual fund works. Because GIFT City is relatively a new jurisdiction, people might not know much about it. But the good part of it is GIFT City is under the Indian regulations and part of the India ecosystem. So it's the best practices that we see, which SEBI has enforced for mutual funds and other financial products, can be carried out through GIFT City. In GIFT City, there is a different regulator called as IFSCA.
Okay.
But there are many members of IFSCA are ex-SEBI from a regulation point of view.
Yeah.
So it's a transparent regulator, one friendly regulator. And I'm sure if investors educate themselves, it should not be that difficult to invest.
All right. So it's relatively convenient to invest via.
In GIFT City, different type of products are allowed: AIF, PMS, mutual funds, etc. Each one of them have a ticket size. So mutual funds are retail, so the ticket size will be smaller. PMSs are slightly bigger ticket size, and AIF are about $150,000 plus. So you have different points of financial products which are there. The main difference is that in GIFT City, all products which are there are all denominated in dollars. So while you invest in India, everything that you invest in India is in INR terms or in Indian rupees. Everything that you invest via GIFT City is in foreign currency. As per FEMA guidelines, GIFT City is not considered part of India.
Oh.
And because it's not considered part of India, the transactions that you do in GIFT City are in foreign currencies.
Oh.
Because it's again not part of India, some other laws like STT, GST, etc. are far more friendly compared to the Indian regulations.
Okay. So for all these avenues, including GIFT City and the other avenues as well, what are some basic rules that an investor should know?
See, when it comes to investing, basic rule of investing, I'll start with something, my role model, Warren Buffett, and I keep quoting him many times. He said there are only two rules of investing. Rule number 1, don't lose money. Rule number 2, don't forget rule number 1. Right. So if you want to make money in markets, the reason you invest is to be able to create wealth. And if you want to create wealth, you have to educate yourself, learn about it, follow discipline of investing, follow asset allocation, do your own research and invest. None of these rules change whether you invest in a mutual fund, whether you buy stocks, whether you buy a GIFT City fund, or you invest into global markets. None of the rules changes. The main thing is investors need to be disciplined. It's always said that time in the market is more important than timing the market. Right. So spend time in the market, educate yourself. At corrections, don't panic. Look at your long-term goals, and based on your goals, make your investments. And hence, if you do that, then investing is not so complicated. I'll maybe give an analogy here to explain.
Sure.
If you're going to send your kid abroad to study after 10 years, and you are scared that the currency currently at 95, 96, what it will be after 10 years, then you should think, why don't I start investing into global markets? Because as the currency depreciates, when you invest into global markets, it actually helps you. The rupee depreciation helps you. And at the time after 10 years, when your kid wants to go abroad, maybe in US, you will maybe redeem out and your dollars will be converted. So at that time, maybe if the rupee is 120, so be it. And you can take advantage of that. And if your goal is aligned that, I want to keep this money for my kids' education, I should not withdraw the money before 10 years. If you give time to this investment, then I'm sure the investment journey will be far easier and will be far more rewarding than someone who looks at the TV and decides when should I buy and when should I sell.
Right. So the basic principles still apply.
Absolutely, they don't change.
Right. Now, can you tell me more about the taxation about all these avenues, including GIFT City, when it comes to global investing in general?
So I'm a Gujarati and I always say that when you start investing, the only thing that you can control is tax. So manage your investments in such a manner that you can save the tax. When it comes to investing outside India, tax laws are fairly simple. If you invest for a period greater than 2 years, taxation is at 12.5%, which is at par with Indian equities. So if you see long-term capital gains in India, whether you buy shares, mutual funds, etc., equity as the underlying is 12.5%. Here, instead of the holding period being 1 year, the holding period is 2 years. If, however, your holding period is less than 2 years, the tax becomes marginal tax.
Oh.
So based on the investor's slab rate. So investors need to give time to the investment. That's the only difference I would say compared to Indian equities where the time frame is slightly shorter. If investors are investing under the mutual fund route, as per law in India, the tax liability is based on the investor's holding period. If investors invest via a GIFT City fund and under an AIF structure, then the taxation is based on at the fund level.
Okay.
And not at the investor level. So the fund will pay tax based on the time it has held the units or the securities. And the investor's holding period doesn't matter. That's how the taxation moves in case you invest in an AIF structured in the GIFT City.
Okay.
But the main point is, as far as possible, the fund or the investor has to hold for more than 2 years for it to be more tax efficient.
Okay, so time in these investments matters
Absolutely.
a lot.
Absolutely.
When it comes to, let's say, mistakes
Sure.
or pitfalls, so what pitfalls should investors avoid? What pitfalls do they usually find themselves in? And what do you advise to avoid these?
So I would say pitfall comes by not following the discipline of investing. The first point, like I said, give time to your investments. If you give time to your investments over long periods of time, most probably you will not go wrong. The pitfall could be that, if you start seeing that my neighbor is investing in market and he's made money, I should also invest. What happens, the neighbor of yours and your risk profile might not be the same. So if he's bought a Mercedes by his investments, not necessarily you will be able to do it because your risk profile might be different. So invest based on your risk profile and the quantum of risk that you want to invest in. Don't chase returns. And what happens in any market, we keep saying whether it's stocks, funds, countries, etc. You chase something which has done very well. And markets will tell you something which has done terrifically well also goes through two things, which is either time correction or price correction. So you have to be patient. Investing is more like a marathon rather than a sprint. So run it, pace yourself well, and don't just look at, is someone making more money than me? It doesn't matter if someone is making more money than you. You have to see, can I invest based on my risk profile? And if you can do that, I think so you should have a better experience.
Okay, if somebody decides to create a portfolio dedicated to global investments, or they want to allocate some percentage of their existing domestic portfolio to
Sure.
global investments, so how should they do that? How should they construct their portfolio?
Like I said, India is 3-4% of the world, which means 96-97% of the opportunities are not in India. Ideally, I would believe 10 to 20% allocation should be made outside India. This helps you de-risk yourself from one country, one economy risk. The routes we discussed, whether it's mutual fund, gift, etc. I always believe that the most important thing when it comes to investing is taking the right advice and leaving it to the expert. Let's take an example that you are sick. And if you're sick, you might have a couple of home remedies and you still don't get well. What do? You go to the doctor and you consult him and say, I'm not feeling well, what should I do? And the doctor will give you some medicine. You don't argue with the doctor, right? You say, okay, he has skill, he understands what to do and I should follow it. And eventually, in most cases, you will sort of get cured. Now, when it comes to investing, I would say it's the same thing. Take help of an advisor. The advisor could be Sharekhan, who can tell you where to invest, what to do. And take help of an asset manager, who can manage your money well. So both an advisor and an asset manager, experts in telling you where to invest, what to do, are very, very important for investors to start the discipline of investing, rather than investors saying, oh, let me do everything on my own. Everything on my own is not possible for everyone.
Yes.
And the need of a helping hand will definitely be good for investors.
Right. So 10 to 20%, and of course you need someone to take the wheel, at least at the start.
Yeah, absolutely.
Right. So now to sum it up, what are the top 3 pieces of advice that you have for Indian investors who want to get started with their global investments?
First rule of investing outside India would be that decide the allocation based on your risk profile.
Okay.
So if you are aggressive, you can go to a higher allocation. If you are conservative, start slow. Second is, like you invest in Indian markets, the same is a concept with global markets. Invest with a longer time frame in mind, or with a goal in mind, maybe could be 3 years, 5 years, etc. Because the taxation, as if I told you,
yes,
before 2 years is not that efficient.
Right.
So it makes sense to give a longer time frame to invest. And third is take help of the advisor, or I would believe the manager who has the skill, expertise of managing global money. One mistake that some of investors do is that when it comes to global investing, they think a guy sitting in India might have the equal skill compared to a guy sitting outside India. Now the guy who's got maybe a global asset manager, like suppose like Mirae, who has presence in so many countries, might have more knowledge, skill of global markets than maybe an Indian asset manager who just tracks India and has no presence outside. So even within the advisor or the asset manager that you choose, you have to see what is the skill and expertise they have in making your allocation. So idea is go with the right people, go with the right product, and go with the right time frame and mind frame while you make your investments.
Right. Thank you so much for joining us today. You broke everything down in a very simple manner, because a lot of people find this a very new and intimidating space if they're not already familiar with this. So thank you so much.
I'll just maybe end by saying investing is not complicated if you keep it simple, and globally maybe buy products or funds that you know you consume. So that comfort level is high. So start easy, and as you get more confidence, continue to explore globally. All of us like to travel globally, like to explore different countries.
Yes.
Why don't you explore investing outside as well?
Nice way to sum it up.
Thank you.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.